This is prepared by Standard and Poor's, and this is a macro report, and it talks about, of course, this is a little old. It talks about rapid economic growth of 7.2%, how much FDI is coming, which state accounted for largest share of FDI, GDP growth rate. Okay, and then yeah, now it talks about construction output rose. It did very well, construction sector, so to speak. And then trade, hotels, transportation, communication services were up 9.2% year on year. And so this sector did very well. And so what does that mean? That companies within this sector or within this industry also did very well. Okay, but it doesn't talk about which companies. Okay, and then electricity output, very rapid growth. Because why is that? One is because a lot of companies are expanding, so they need electricity for their factories, etc. So that's a sign of economic, uh, I would say, economic revival or economic activity, good economic activity. Okay, so and also um, household, it was quite hot summer, and also household electricity demand was very high. So what does that mean? So see, you have to act like a detective. So you need to connect the dots. And so, for example, a detective goes to a, I don't know, robbery scene or a murder scene. He or she does not only look at that particular place. He expands his sphere of search. So little, expands in the sense that he looks at what the neighborhood near, here and there, and for some clues. So a statement like this, electricity, and there was strong electricity demand from households due to hot summer weather conditions. What does that mean? That means probably you have good demand from for air conditioners, for air coolers, etc. And so that means that you should look at companies that make these equipment, and see how they are affected, the demand pattern for air conditioners or air coolers, etc. So that's how you connect the dots. And as a good analyst, you need to be quite open. Keep your eyes and ears open, and you need to have that curiosity and the ability to sort of dig down, dig through the numbers, and make the association. Okay, so output of infrastructure and construction goods rose. So there's a very hard push from the government for infrastructure projects, and so that is basically shown by this strong, uh, per year-on-year growth rate. And so you see who are all those companies who are into this infrastructure space. So it's definitely, you can make that connection. So PMI, purchasing managers, what is that indication? But back to this. So every month you get this PMI. PMI is basically a survey of purchasing managers of some select companies, and then so on the basis of that, they talk about, they create a survey uh, which says that it's a forward-looking survey, and it says that these purchasing managers, their sentiment rather. So it's a good sentiment. Uh, there's some sort of relation, and services business activity index. So services means, for example, professional services or IT services, etc. And how that performance has been. So exports, and so another thing they are saying that CPI inflation pressures have moderated. And so inflation is sort of coming down, and or rather it is increasing at a slower rate, uh, inflation. And so definitely has a very good effect on the market. I'm sure when this report came up, the market might have risen. And so what does that mean? If inflation is seen as reducing, that means that probably RBI will not raise rates. And so what happens? And if inflation persists, at a manageable rate, then RBI may even think of reducing rates. Okay, and that is what they sort of said in the last meeting, is that our our rate increase regime is sort of coming to an end. And so they will either hold the rate the same, or they may even think of reducing the rate. So immediately it brought cheer to the market. Why is that? Because when interest rates reduce, companies can take more loans from banks at lower interest rates. So the capex cycle will start. Capex is capital expansion. So they, some companies which see good demand from the market, they may invest more in more machines. They may open new factories, etc. Because cost of capital is less. And so, uh, that is one. The other thing, so it will spur manufacturing activity. Another area where it will spur activity is in the home real estate market, because then banks will, if interest rates reduce, then banks also will reduce home loan rates. And so home buyers will find loans to be cheaper, and so that will spur more real estate demand. And so what happens, the not only the home builders will find it good, but also other ancillary industries. So for example, when a home builder builds a home, then they have demand for copper wires or aluminum wires, electrical equipment. Then you have sanitary ware. Then you have paints. So you see this wide cross section of industries and companies that are affected in a positive manner when interest rates go down. But again, as I said, it is not there is not a sort of 100% correlation between the fact that if interest rates reduce, it brings good tidings to companies, or if interest rates rise, um, things become bad for everyone. Now what happens is, for banks, if interest rate increases, then generally speaking, banks are happy. Okay, if interest rates rise, so they are able to lend at higher rates, while their lending interest rate is always higher than their deposit, what they pay the depositors. Okay, so they make money through that spread, which is called net interest margin. And so there's always a lag. So they immediately raise rates, whereas they take their own sweet time in raising the deposit rates. Okay, so the lag is always there. And so what happens is that immediately they are able to give out loans at higher interest rates, and so it increases their profitability. But then as time goes on, they find that they have lesser and lesser loans people are asking. Why is that? Because loans are becoming costlier, and so they find that lesser number of companies are asking them for loans. So it's a sort of a double-edged sword, in the sense that prolonged high interest rates, while initially being a good thing for banks, if it keeps on increasing, then it ultimately hurts them also. Okay, so CPI is that, and then energy prices. Yeah, so CPI, inflation rates, mostly why the inflation rate was in the past was quite high, was because of the high energy prices, that is oil prices. But they have eased in 2023. So there is a moderation. Okay, so food and beverages. So it's a very comprehensive report that all these brokerage companies, they put out like once a month or something, and then an economic outlook. So they say that GDP will increase, and which sectors will benefit because of this GDP increase. So they say the e-commerce and the shift to 4G and 5G, homegrown unicorns. They mentioned delivery and big basket and everything. And so now what happens is that the analyst looks at that, and then they prepare their analysis on which sectors will benefit from this. Okay, so here I have a report on the financials, India financials. This is Jeffries is a brokerage company. Okay, so he talks about all companies in the financial services sector. Okay, whether it's a public sector bank, private sector bank, or whether it's an NBFC or even a life insurance company or non-life company, everything. They talk about the entire financial services landscape. Okay, and so this is a sector report. Okay, and things like, so these are the data points that I spoke about: loan growth and net interest margin. Okay, and also the mutual fund companies. It does the analysis. So these are the data points. So non-performing loans as a percentage of total loans. Okay, private banks and public sector banks. Then slippages. So that means that how much of their loans become bad. Okay, and you see in 16, 15, 16, 17, it used to be quite high, and so now it is going down because of the all of the strict guidelines given by RBI. Okay, so then credit cost of bank. So banks also, where do the banks get money to lend? Some amount of money is available um, from the customer deposits, but then a majority of the money, even banks have to go and borrow money. Okay, so the credit cost is an important input cost, and so they, generally speaking, they want to keep their credit cost low. Okay, so they go out and periodically they seek out cheaper loans. This is where even high interest rates hit the banks also. And then return on assets. Okay, and in the banking industry, return on asset is a very important metric of profitability. Okay, and then you have, okay, so the banks that they compare are HDFC Bank, ICICI, Axis, Kotak, and IndusInd. And then among the public sector banks, they consider SBI and PNB, Punjab National Bank. Okay, and so they over time they sort of analyze how the bank margins. Okay, how is their net interest margin, and then loan pricing benchmark. What is the benchmark based on which they give loans according to the credit rating of the customer. Okay, so net interest income. This is a NII is the net interest income, and the spread between weighted average lending rate and term deposit rate. Delinquency, like how many loans have become bad, and slippages. So like there's a wide range of data that they provide for this banking sector. So we covered macro, and then we covered industry, and now we are finally, from this we are able to select the appropriate industry that one can invest in, because it's not static. Depending on market conditions, depending on economic conditions, you adjust your sector weightings. So for example, I say that I have my fund has about 100 crores that needs to be invested in. So so what are the sectors that I'm going to look at? So based on this analysis, based on the macro, based on economic situation, etc., I say that my sector weightings are going to be this. So much of For example, 10% should be in this sector, 12% should be in that sector, 13% should be in this sector. And again, there is a science behind this. One does not just pluck it from thin air. And then once you decide on which sector, then you drill down and then you analyze companies within that sector. So you take which is the top performing company in that sector. So for example, when we saw in the banking industry, we saw certain banks, and we saw certain public sector banks, private sector banks. So then we can all of those banks are our candidates for investing in that particular sector. And then when we do the company analysis, then out of those companies, then we are able to understand, or we are able to decide, okay, which is the top company in this sector. So maybe we invest in the top three companies in the sector. So again, that depends on the philosophy. So for example, again, to recap, macro, you get information about interest rates, what is the FDI investments, things like PLI scheme. Okay, and in the industry, we have input costs, demand, technology, operations, etc. And then the company, the metrics or the filters of the on the basis of which we analyze the companies are profits, sales, debt. How is it how is it sort of managing its debt and liabilities, and lastly, the strength and quality of its management. Okay, so these are the sort of the top-down analysis guidelines that go into analysis of a stock. So you don't you don't immediately jump to analyzing the company. So you have to be a little conscious of where this company exists in this ecosystem. Okay, so that's next. Okay, so this is the sort of the process. So if I'm a mutual fund or a portfolio manager, this is what I do. I first identify. I have a so when I'm starting a new fund, so what I do is, first of all, my initial corpus is there, and then I say that, okay, I'm going to be a growth fund, or I'm going to be a value fund, or what is my theme, okay, or I'm a combination of both, or growth at a certain price, okay. So I'm not going to be chasing growth stocks, but at a reasonable price I'm going to buy. Okay. And so I'm going to identify companies. Okay. But first, I'm going to fix my benchmark. Okay. What is my benchmark? That is, what is the benchmark based upon which I will compare my performance? So there are lots of benchmarks, lots of indices. Nifty, of course, Nifty 50 is there. Nifty 500 is the broad-based index. Then if I do a sector fund, then I have Nifty, Bank Nifty I have, then Nifty Financial Services, which is more broad-based, and then I have Nifty IT, I have Nifty, I don't know, consumption, etc. Or if I'm doing international stocks, I have MSCI World Index or MSCI EFA Index, etc. So first I have to decide what is going to be my benchmark. Okay, so then what I'm going to do is I'm going to identify stocks which I'm going to target, or which I'm going to select from. Okay, this is my broad base from where I'm going to pick up my stock. So that is called the universe. Okay, now within that stock, you have so many kinds of stocks. So, for example, you're casting a wide net in the ocean, and then you get 100 different kinds of fish. You get crabs, you get shrimp, you get all sorts of things. So that is my sort of the huge universe. Now, out of that, but I've gone to fish for only shrimp. Okay, so then I select that, and then I throw away everything else, and then then I have only the shrimp, and within the shrimp, the since I'm a sort of a conscious fisherman, I throw away small babies. I throw away, I mean, back into the ocean. I throw away females. Okay, and then only a certain type of uh, prawns that I keep in the net. And so these are the prawns that I'm going to further see and analyze. So like the same thing like that is the stocks. So first I get a fairly huge universe. Out of that, I create what is known as the investable universe. Okay, so this is the universe of stocks that have passed the test of being investable. Okay, so how do I do that? There are certain criteria. So I discard illiquid stocks. Okay, what does that mean? So for example, I look at trading volume. Okay, and then I look at a 3 month trading volume. Okay, so a 3 month trading volume has to be above uh, so much, this number. Okay, and then I look at I don't want to invest in loss making companies, or maybe I don't want to invest in what is known as sin stocks, sin stocks. So for example, I don't want to invest in companies which make alcohol or make cigarettes, things like that, which are harmful. Okay, again, it depends. Some funds may hold it, some other funds may not hold it. So they have a certain set of criteria, and so then out of that comes the investable universe. Okay, then maybe a certain market cap. Okay, I don't want to invest in very small companies. Okay, and a market cap has to be within this range, so that can be another criteria. And so from there I get the investable universe. So once I have the investable universe, then my job of analysis starts. Okay, so now after analysis, I have sort of selected some number of stocks. Okay, so what are those the criteria to do the analysis? That is what I'm going to cover next. But what we will do is that, now let us say that we have analyzed, and then I have a list of about 25 to 30 stocks out of the top sort of performing stocks according to my criteria. Okay, and now I have to value those stocks. Okay, after analysis comes the value. Okay, so now is begins the task of valuation. So see this, how step by step the actual process flows. Okay, so it's not enough to just immediately jump into equity valuation and do all the financial modeling without understanding the overall picture. In a mutual fund, or a private uh, PMS, which is a portfolio management service, that is the individual manager. This is the process. Generally, this is the process. So then you apply your valuation criteria, etc., and then once you so out of that, what do you get? You get what is the true value of the stock, what is the intrinsic value of the stock. Okay, then you compare with what the stock is currently being, what the market is asking, what is the price of the stock. So that's where you have the difference between the value and the price. Okay, so then you say, okay, is this undervalued, or is it overvalued, or is it justly valued? And if it's undervalued, then it's a good buy. So you may overweight. You may buy the stock in large volumes of stock you can buy, and even slightly overvalued stocks are okay, because you are in it for the long term. Okay, so then the market will adjust itself. and only gross overvaluation you want to avoid. Um, some of these, internet companies, every one of them were making loss. Okay, huge loss, and you see the price run up of those companies. I mean, it was ridiculous. One day they will go up, another day they'll come down, and it was absolutely ridiculous, and they were hugely overvalued. And so a value investor will never even touch these stocks. And so you look at valuation, and you look at the value versus price, and you make a decision. So, and then allocate is basically how much. Once you say that, yeah, it is, this stock is undervalued, or if it is justly valued, and it's a good candidate to enter into my portfolio. Now, how much to allocate? Okay, so for example, if I have 1 crore, now out of 1 crore, maybe initially I said it's going to be an equal weighted portfolio. So 30 stocks equally divided. So that 1 crore will be equally divided among these 30 stocks. So now, if I find a stock which is like super candidate, so maybe what I'll do is I'll increase its weight in the portfolio. Okay, and then reduce the weight for some other stock. So basically, out of this analysis, I get a ranking. So the top performing stock, then the second, number one, number two, number three, and then number 30. Okay, so maybe the number one stock, I will allocate, I will overweight, and then the number 30 stock I will underweight. So actually speaking, it no longer is a equally weighted portfolio. So it depends on the individual portfolio manager whether he wants to keep it a rigid, equally weighted, or depend. You can do some minor changes here and there. So that is the allocation. So this is the process of identifying a security, identifying a stock, analyzing, valuing, coming up with the true value, and then allocating it into the portfolio. And then you monitor the portfolio on a continuous basis to see, what is the criteria. So you say that, for example, I don't want a stock that you know just goes up and up and up, because there has to be some discipline. So you say that a stock which increases in 20%, its weight, let's say, increases 20%, then immediately I'm going to sell the stock. Okay, so when I sell the stock, then I have to buy, how much of money I make, that much money I have to allocate to another stock. So you see this ranking that I've created as a result of this analysis. Now I run this analysis on a daily basis. So every day it gives me a ranking. So then whichever stock is not in this ranking, and which is the top in that, I allocate that money to this particular stock. So that is one option. The other option is that I increase the weights to in let's say the number two stock. Okay, but that entirely depends on the investing philosophy of the manager. Okay, and so this is how a portfolio is created. The portfolio is managed on a continuous basis, and then you buy and sell securities out of that. Okay, so now, so basically analyze the company and value the stock. That is very important. So this is the This is the sort of the investing life cycle. So from the universe, you come to investable universe, then portfolio of stocks, and then analysis, and then valuation and allocation. Okay. What is the $64 million question? This is now we have come to the analysis part, and I will just give you an sort of a flavor of the five filters for analysis, and then I will continue it in the next class. Okay, so these are the five factors. When I have a stock or a company, to analyze, on what basis do I do the analysis? So one is on a growth basis, then a profitability, financial health, risks, and then quality of management. Each of these is very important, and there are metrics. There are growth metrics, there are profitability metrics. So these are basically the financial ratios, what we call them, health and the risks and quality of management. Based on this, we analyze, and then we come up with the ranking. Okay, then valuation is, you apply, for example, dividend discount model, or cash flow analysis, or earnings growth model. So these are all the standard, what you find in books. I want to go slowly, step, you are able to understand the concepts and from the first principles, and not just jump. Everybody, I know that everybody wants financial modeling and investment banking, financial modeling, but this is the foundation. Once you are once your funda is good in this, once you understand the basics of what analysis is and what valuation is, everything, then you can do anything. You can be in corporate finance, you can be in investment management, you can be in risk management, anywhere, any role basically uses 4 or 5 of these first principles. So if your first principle is strong, then I think you can be in any industry.